If you're an investor, you've probably had to make a decision about how to allocate the percentage of stocks versus bonds in your portfolio at some point. This is known as asset allocation, and it's an important concept for increasing and preserving the value of the assets in your portfolio over time. Now, a common approach is to choose a ratio of stocks and bonds based on your risk tolerance and your age, and then adjust the level of stocks and bonds that you own accordingly to that. Now, typically, this sort of approach results in a split of stocks and bonds represented by two numbers that total 100%. So like a 60-40 portfolio would contain 60% stocks and 40% bonds, while an 80-20 portfolio would contain 80% stocks and 20% bonds. And even though these are generally good approaches, I'm going to show you today why you might want to base your own asset allocation on a completely different factor altogether. Now this video is full of data, so we're going to jump right into it so I can explain why I think there's a better way to approach asset allocation than just a typical 60-40, 70-30 ratio approach. Now the first thing I want to show you is a table that summarizes the performance of investing periods that were 1 to 10 years in length, going all the way back to 1928. I'm not going to spend a lot of time on the table because I have a better graph that will illustrate the data that's on this table a little better in a second. But in summary, the range column on the far left contains the durations of each investment period. You got 1 year periods, 2 year periods, 3 year periods, 4, 5, 6, 7, 8, all the way through 10. And to the right of that are two investment types. The first is a portfolio that mimics the S&P 500 as it would have been all the way back to 1928. Now under that S&P 500 and bond sections of the table, the lowest performing periods are recorded with the minimum. The highest performing periods recorded, that's the max. The average rate of return and the number of periods that ended positively or negatively are all listed for each period. And of course, further to the right is the same information for a blended portfolio of treasuries, corporate bonds, and municipal bonds. All right, now let's look at this same data summarized in a graph. And this is kind of a lot to take in. I'm going to talk slowly as you sort of digest all the graphics numbers that are on your screen. I apologize, it's kind of a busy chart. But I felt like I needed to get everything in one place so it could be really discerned. So each clustered column in this graph represents all the 1 year, 2 year, 3 year, and so on periods of performance for the S&P 500, those are in red, and a mix of bonds, that's in blue, going all the way back to 1928. So for example, the very first column to the left illustrates the minimum and maximum values of all the 1 year periods going all the way back to 1928. So in this case, the highest period for stocks was 52.56%, while the best year for bonds was 24.15%. Now naturally, the longer each period is, the smaller the range of outcomes from min to max because it's averaging that data over a longer period of time. The lines going across the top half of the chart illustrate the number of periods that ended above zero or they gained value versus the number that lost value. The top lines are the number of periods that gained value, while the lines on the bottom are the losers. Now one nuance I do want to point out, because you may catch what you might think is a glitch in the numbers, is that there's one less period for each year that you add to the length of an evaluated range. So there were 97 one-year periods since 1928, but only 95 three-year periods because the first three-year period didn't start until the end of 1930. You didn't have the data to evaluate a three-year period until a three-year period had elapsed, so there are fewer three-year periods. So in total, there are 97 one-year periods and there are 88 10-year periods. So next, before we go any further, I want to highlight a common error that investors make when they see data like this, and that is that they mistake volatility for risk. And here's what I mean by that. Now, obviously, the value ranges for bonds is far more stable and less volatile than stocks in this graph. Bonds just don't jump around in price nearly as quickly or drastically. But that doesn't necessarily mean that bonds are lower risk. So for example, if you owned a portfolio that was completely full of junk bonds, you may have a very stable yield for a time, but if the issuer of those bonds goes bankrupt, then your yields are gone along with the issue price of the bond. You'll never get that money back, which is obviously a really poor return on your investment. Now, it's absolutely true that volatility is a component of risk, but it is not the only factor. You can't look at a chart like this and assume that bonds are always less risky than stocks. That's simply not the case. I'm highlighting this because this concept, this idea of volatility and risk is going to come up frequently in this video. Next, I want to highlight several observations I made after this graph was created. But first, if you've been watching the channel for a while, or if this information is helpful to you, if you would please consider clicking like and subscribe below. That really helps my channel to grow and allows me to keep making videos like this. So here are 5 quick observations I made that I want to highlight before summarizing several of the conclusions I feel like this data is leading us to. So the first observation is it is risky to own stocks for 5 years or less. If you had owned a basket of stocks for any 1 to 5 year period going all the way back to 1928, you would have lost money 6.5% to 26.5% of the time. Now, I realize that 6.5% may not seem like a high probability, but given the potential impact of a delayed or less exciting retirement or the delayed purchase of a home or whatever you're saving for, it would be a lot to risk. Personally, I wouldn't take a 1 in 15 chance of my retirement being delayed when the fix is simply to de-risk my portfolio by investing elsewhere. Or maybe your kid will have to take out student loans instead of going to college without debt, or you won't get to buy the house you've been saving for. These are all costly outcomes if markets suddenly turn south. The second observation is it is risky to own bonds for less than 2 years. Now, consistent with the idea that bonds are not always low risk, there's a 10.6% chance, that's 11 out of 97 periods, that your bonds would lose value if you held them for 1 year or less. However, unlike stocks, bonds would have only lost money 1 to 3% of the time if you held them for 2 to 4 years and never for any period longer than 4 years. Now, you may be asking yourself, if I can't own stocks for 5 years or less, and I can't own bonds for less than 2 years, what would I hold for periods of 0 to 2 years? For now, I'm going to ask you to just hang on to that question. We're going to come back to it in just a minute. Observation number 3 is the risk-reward trade-off begins to strongly favor stocks at 7 years. Of the 91 periods that were 7 years or longer, only one lost value, that being the years leading up to the 2008 financial crisis. And even in that case, the loss was only 1.6%, so I'd hardly classify it as a catastrophic event. Also, in those 7, 8, and 9 year periods that led up to the 2008 financial crisis, if you held on to your investment for just one more year through 2009, you would have been back to enjoying positive returns in your portfolio. Observation number 4 is the risk reward for bonds is strongest in the 2 to 5 year range. Like I've already said, in the 2 to 5 year range, only 1 to 3% of the periods for bonds ended negatively. And you compare that to stocks, where 6.5 to 16.7% of periods ended negatively, and you can understand why the stability of bonds is favored in this window. Observation number 5 is year 6 is where bonds really begin to lose their luster compared to stocks. The average rate of return for 6 year periods of stocks and bonds is 5.21% for bonds and 11.96% for stocks. That's more than double the return for only 3.2% greater risk that you'll have a negative outcome. Now, for many of us, especially those of us who are in the building stages of our portfolios, this trade-off is worth the move towards stocks for money that isn't needed for the next 6 years. Put another way, the superior returns of stocks are too good to pass up compared to the slightly lower risk and the much lower returns of bonds. So you might be thinking to yourself, Curt, this data is great, but what are you suggesting that this means for my asset allocation in my own portfolio? Well, I'm glad you asked that question. Let's walk through 3 takeaways based on the information that we've been covering so far. The first one being a ratio asset allocation may not be optimal. I've already hinted at this a little bit, but setting an asset allocation to a given ratio may or may not be suitable for you. So for example, assume your portfolio is valued at $2 million and you plan to withdraw $80,000 each year for annual living expenses. That's a 4% withdrawal rate. A 70-30 portfolio would be suitable in this case because 30% or $600,000 of your portfolio that are in bonds would cover 7.5 years of living expenses. It's a little on the conservative side, but it's not out of line. On the other hand, what if your portfolio value was $5 million and you still had that 70-30 allocation? That would be 25 years of expenses covered in bonds. Do you really need that much time in a fixed income asset? And what if the portfolio value was only $800,000? That would only be 3 years of the portfolio value in bonds. That seems very risky to me. And to be honest, in that case, I would just suggest that you actually work more instead of starting a 10% annual withdrawal rate, but that's another subject. So yes, in many cases, asset allocation ratios will work just fine, but they are too general to be a one-size-fits-all strategy. All right, takeaway number 2 is asset allocation should be based on time frame of your investment. So to me, this is the primary takeaway from this whole video. If your goal is to optimize or maximize your portfolio's value, then you should approach asset allocation based on how many years you have between now and when you need to liquidate the investment and use the money. To help illustrate this point, I've created a scatter plot so you can see the performance of bonds and stock portfolios over time. This scatter plot actually captures 2 to 5 year periods all the way back to 1928. And there's a couple things that probably stand out immediately. First, stocks are obviously more volatile than bonds. We've already covered that. The range of red is much greater than that of the blues on the graph. Red represents stocks, blues represent bonds. The second point is that the good years for stocks dramatically outpace those of bonds. The reds go much higher in the graph than bonds ever reach or get close to. But you'll also note that there are plenty of periods where stocks lost value. There's actually 44 red dots on this chart that are below the zero line. Now there's enough downside risk here to persuade me to choose an investment other than stocks for a period of 2 to 5 years. Now let's look at a similar chart for stocks and bonds owned for periods of 6 to 10 years. You'll note that there's still greater volatility in stocks, though it is much lower over a longer period of time, and the highest highs for stocks still far outpace bonds. But you should also note that there are very few red dots that land below zero in this chart. There's only 6 of them compared to the 44 that were in the 2 to 5 year chart. Now my conclusion from this chart is that it would be wise to choose stocks for periods of 6+ years in length because the potential gains outweigh my concerns about periods of negative returns. So in summary, for investment periods of 0 to 2 years, stay in cash, savings, CDs, or money market accounts. That's just to preserve the capital that you have for the time of need in that short window. For periods of 2 to 5 years, check out the yield curve and invest where it makes sense. It's either going to be short-term debt or long-term debt, being short-term bonds or long-term bonds. And finally, for investment periods of 7 years or more, I would invest in stocks. And if you're still on the fence at the 5 to 7 year range about stocks or bonds, maybe this last takeaway will help push you towards stocks. As you were looking at these scatter plots, you may have noticed the higher returns on stocks and wondered whether or not the potential for higher returns is worth the additional risk or volatility. Now to evaluate this, I built a graph illustrating the performance of 2 portfolios with an identical annual contribution rate of $5,000 each year for 40 years. Now the key difference is one is completely invested in bonds and the other one in stocks. And as you can see, the stocks did a little better. I used the average rates of return for a 7-year period to run the scenario. So in that case, bonds earned 5.23% annually, while stocks averaged 11.97%. So the final total after 40 years was $4,261,379.28 for stocks and $672,222.76 for bonds. That's a difference of $3,589,156.52. Pretty significant. Now, given this drastic difference in the long-term performance, I would argue that it's much riskier to invest in bonds for 7 or more years, the risk being that you won't have enough money to meet your goals, whatever those are, be it retirement, the purchase of a home, putting a kid through school, whatever it is. You may not have enough money with bonds. Now, none of the information I've presented is meant to criticize the use of asset allocation by ratios. For most people, it's a very suitable way to guide investment choices and force healthy rebalancing as these non-correlated asset types ebb and flow with market forces. However, they're not really the optimal way to arrange your portfolio, assuming that you want it to grow as much as possible. If you really want to optimize things, focus on time until you need the money, not just a random ratio. So for more about investing, please check out our investing page at martinmoney.com or our investing playlist. Both of those will be linked down below. As always, I'm grateful for your time and your interest in my videos. God bless and take care.